Have you ever wondered how financial giants like AT&T and Verizon are performing in the telecom industry? Let's dive into the numbers and see who's leading the pack. First, let's talk about total revenues. By the end of the last 3 quarters of 2023, AT&T had managed to rake in a whopping $90 billion, while Verizon pulled ahead with a total revenue of $99 billion. Now, if we compare these numbers to the same period in 2018, we can see some interesting trends. 5 years ago, AT&T's revenue was a staggering $123 billion, but unfortunately, they've seen a compound annual growth rate, or CAGR, of -6% since then. On the other hand, Verizon's revenue back in 2018 was $96.6 billion, and they've managed a modest CAGR of 0.5% over the last 5 years. Now let's rewind and look at the bigger picture. Up until 2021, AT&T consistently outperformed Verizon in terms of revenue. However, the tables turned in 2022 when Verizon's revenue surpassed AT&T's for the first time. A closer look at their revenue structures might shed some light on this shift. AT&T's revenue primarily comes from mobility, business wireline, consumer wireline, and Latin America. Mexico, making up 68%, 18%, 11%, and 3% of their total revenue, respectively. In contrast, Verizon's revenue is more focused on their wireless services, Fios revenue, wireless equipment, and other, contributing 58%, 10%, 14%, and 18% respectively. This difference in focus might be the reason why Verizon has managed to overtake AT&T in the revenue race. So in the revenue race, Verizon seems to have taken the lead, but what about profit margins? Profit margins are a key indicator of a company's profitability. Let's delve into AT&T and Verizon's profit margins. In the competitive telecom industry, understanding profit margins can give us a sense of how well a company is managing its costs. Gross profit margin essentially tells us what proportion of money from sales a company keeps, after subtracting the cost of producing its goods or services. In this case, AT&T's gross profit margin stands at 44%, while Verizon's is slightly higher at 47%. But let's not stop at gross profit margins. Net profits, the holy grail of profitability, deserve a closer look. For AT&T, the net profit is $12 billion. Verizon, on the other hand, brings in a net profit of $14 billion. This reflects the money these companies retain after all expenses, taxes, and costs have been paid. It's the ultimate measure of profitability. But let's add another layer to this analysis. Over the last 5 years, AT&T has seen a negative growth rate of net profit at -4%. This means that AT&T's net profit has been shrinking. Conversely, Verizon has a positive growth rate of 0.6%. This shows us that Verizon's net profit has been growing, albeit modestly. One important thing to note here is that both AT&T and Verizon have similar net profit margins at 14%. This ratio tells us how much each company earns in profit for every dollar of revenue it generates. In other words, for every dollar of revenue, both AT&T and Verizon are earning 14 cents in profit. So, what does all this mean? While both companies are profitable, they present different pictures when it comes to growth. AT&T seems to be facing challenges in growing its net profit, while Verizon is managing to inch forward. While both companies have similar net profit margins, Verizon leads in terms of net profit growth. Assets are a company's resources, but who has the most resources between AT&T and Verizon? Let's dive into it. In terms of total assets, AT&T comes out on top with $407 billion, while Verizon isn't too far behind with $385 billion. But it's not just the total assets that matter, it's what makes up those assets that's really intriguing. Now you might be wondering, what are these assets composed of? Well, for both AT&T and Verizon, a significant proportion of their assets are tied up in property, equipment, and licenses. This isn't surprising given the nature of the telecommunications industry, where substantial investments in infrastructure are a prerequisite for operation. For AT&T, property, equipment, and licenses account for a whopping 63% of their total assets. Verizon, on the other hand, has an even higher proportion at 68%. This high dependency on property, equipment, and licenses underscores the capital-intensive nature of the telecommunications industry and the barriers to entry for new players. But what about the rest of their assets? For AT&T, the remaining 37% is spread across a variety of areas including investments, accounts receivable, and cash and equivalents. Similarly, Verizon's remaining 32% is also diversified across various asset classes. In conclusion, while AT&T has a higher total asset value, both companies heavily rely on property, equipment, and licenses. This dependence on high-value assets not only highlights the substantial investments required in the telecommunications industry, but also the significant value tied up in these assets. This, in turn, influences the financial performance and strategic decisions of these companies. So, the next time you think about investing in the telecommunications industry, remember to consider not just the total assets but also the composition of these assets. After all, as the saying goes, it's not just about quantity, it's about quality too. Although AT&T has more total assets, both companies heavily rely on property, equipment, and licenses. Liquidity and operational efficiency are vital for a company's survival. How do AT&T and Verizon fare in these areas? Let's dive in. Liquidity ratios are a good place to start. These ratios measure a company's ability to pay off its short-term liabilities with its short-term assets. The current ratio and quick ratio are two commonly used liquidity ratios. For AT&T, the current ratio is 0.69, while for Verizon it's slightly lower at 0.68. This means both companies have less than $1 of current assets for every dollar of current liabilities, indicating potential short-term liquidity risks. The quick ratio, which excludes inventory from current assets, is also similar for both companies, standing at 0.64. Let's now turn to operational efficiency. A key metric here is accounts receivable days, which measures the average number of days a company takes to collect payment after a sale has been made. AT&T has an impressive figure of 31 days, while Verizon stands at 66 days. This suggests that AT&T is more efficient at collecting payments from its customers. Another operational efficiency metric is total assets turnover, which indicates how efficiently a company uses its assets to generate sales. A higher turnover ratio indicates better efficiency. Verizon, with a total assets turnover of 0.34, outperforms AT&T, which stands at 0.3. This suggests that Verizon is more efficient in using its assets to generate revenue. So, in the battle of liquidity and operational efficiency, it's a mixed bag. Both AT&T and Verizon have similar liquidity ratios, indicating potential short-term liquidity risks. However, when it comes to operational efficiency, AT&T excels in collecting payments quickly, while Verizon is more efficient in utilizing its assets to generate revenue. Both companies have similar liquidity ratios, but Verizon turns its assets into revenues more efficiently. Cash flow is the lifeblood of any business, and the DuPont analysis provides a deeper understanding of a company's return on equity. Let's see how AT&T and Verizon stand. Now let's talk about the operating cash flow, a key indicator of a company's financial health. AT&T's operating cash flow came in at $27 billion, while Verizon generated a slightly higher amount at $29 billion. But it's not just about the money coming in, it's also about the cash that's free to be invested back into the business. Free cash flow, which is operating cash flow minus capital expenditures, was $14 billion for AT&T and $15 billion for Verizon. A higher free cash flow allows a company more flexibility, indicating a slight edge for Verizon here. From a profitability perspective, it's interesting to look at the ratio of operating cash flow to net income. For AT&T, this ratio is 2.2, while for Verizon, it's slightly lower at 2. This means that for every dollar of net income, AT&T generates $2.2 of cash, while Verizon generates $2. Now on to the DuPont analysis, a method that breaks down return on equity into three components: net profit margin, asset turnover ratio, and financial leverage. At the end of the third quarter of 2023, AT&T's return on equity was 14%, with a net profit margin also at 14%, and an asset turnover ratio of 0.3. Its asset-to-equity ratio, a measure of financial leverage, stood at 3.45. Verizon, on the other hand, boasted a higher return on equity of 19%, with a similar net profit margin of 14%. However, it outperformed AT&T in terms of asset turnover, coming in at 0.34, and had a higher asset-to-equity ratio of 3.88. So what does all this mean? Simply put, Verizon seems to have a stronger cash flow and a higher return on equity, indicating a better financial performance. Please comment on the businesses you'd like us to analyze and we'll assist you in our upcoming videos.